Hey everyone, welcome back to Corporate Decoder, the place where we break down the financial wizardry of the world's biggest companies. And today we're diving into Talon Capital Corp's latest filing, and let me tell you there's a lot to unpack in this SPAC debut, especially when it comes to their spectacular plans to go public and find a business to merge with. So picture this Talon Capital Corp, a brand new company aiming to make a big splash in the energy and power sectors by merging with another business. But before they can do that, they need to raise a lot of cash through this initial public offering. Let's decode how they plan to do it and what it means for you. This filing is all about Talon Capital Corp, our registrant, which is a newly formed entity looking to make a big acquisition. They're a blank check company, also known as a special purpose acquisition company, or SPAC, which means they exist solely to raise money and then find a private company to combine with. Unlike other companies, they don't have an existing product or service. Instead, their business is the search for and the eventual purchase of another company. Talon Capital Corp is offering 22,500 units for sale to the public, with each unit costing $10 each. This means they are aiming to raise a massive $225 million just from this initial offering. That's a huge amount of money to start with, and it shows their ambition to make a significant acquisition. Now let's talk about who's holding the reins. Talon Capital Corp's sponsor and management team will own a significant chunk of the company after this, offering around 25% of the outstanding ordinary shares. This means they have a vested interest in making this SPAC successful, but it also raises questions about potential conflicts of interest, especially since their founder shares were bought at a ridiculously low price. Looking at their financials, right after this offering, Talon Capital Corp will have a net tangible book value per share of around $7.11, assuming no exercise of the underwriter's option. This is quite a bit lower than the $10 offering price per unit, which means investors buying in right now are looking at immediate dilution right off the bat. Here we see the breakdown of who owns what. Talon Capital Sponsor LLC, as the sponsor, will be a major player. They bought out 825,000 founder shares for a measly $25,000, which really highlights that bargain they got compared to the public shareholders who are paying $10 per share. The sponsor's investment is a steal. The company has 8,625,000 Class B ordinary shares. This is their founder's stock, which is special because it usually comes with extra voting rights and might convert into Class A shares later on. But what's really interesting is that up to 1,125,000 of these shares could be forfeited if the underwriters don't sell all the extra shares they have an option to buy. Before this whole public offering thing even started, Talon Capital Corp actually had a negative net tangible book value of about $56,000. This is pretty common for SPACs since they haven't really done anything yet beyond setting themselves up. On top of the public offering, Talon Capital Corp is also selling what they call private placement units. These are special units sold directly to the sponsor, and the underwriters Talon Capital Sponsor LLC is buying 530,000 of these at $10 a piece, which is another $5.3 million going into the company's coffers, and the underwriters through Cohen and Company Capital Markets are buying another 225,000 units for over $2 million going into the company's coffers, and the underwriters through Cohen and Company Capital Markets are buying another 225,000 units for over $2 million being into the company's coffers, and the underwriters through Prime and Company Capital Markets are buying another 25,000 units for over $2 million. For the period from their inception in May 2025 up to May 21st, Talon Capital Corp reported zero revenue, but they did have general and administrative costs totaling $16,457. This is pretty much expected as they were just getting started and setting things up, not surprising at all. When we look at their cash flow statement, it shows that their operating activities pretty much used up all the cash they had, with a net cash used in operating activities of zero. This is because they haven't actually operated any business yet. All the cash they've brought in comes from financing activities, especially from the sponsor buying those founder shares. Interestingly, the balance sheet shows $64,798 in deferred offering costs. These are the expenses related to getting this whole public offering off the ground, like legal and accounting fees, and they're waiting to be settled once the offering is complete. The company reported a net loss of $16,457 for the period up to May 21st. Again, this is all startup costs and nothing related to actual business operations. And who is this Talon Capital Sponsor LLC? Well, they're basically the main investors behind the scenes. Charles Latham, who is the CEO and chairman, is also the main guy running the sponsor. This close relationship between management and the sponsor is definitely something to keep an eye on. One of the biggest risks for any SPAC is their ability to actually find a company to merge with Talon Capital. Corp has a 24-month deadline to do this, or else they have to go out of business and return the money to investors. So they're under a lot of pressure to find a good deal quickly. Many of the risks mentioned in this filing really boil down to the fact that the sponsor and management team paid next to nothing for their founder shares. This creates a situation where they could make a huge profit even if the company doesn't do too well after the merger, which could push them towards making a deal just to get it done rather than finding the absolute best opportunity. This is a bit of a head scratcher. They might issue shares to investors in something called a PIPE transaction, which is a private investment in public equity at a price that could be much lower than the market price of their shares later on. This could lead to significant dilution for existing shareholders and basically means early investors in the SPAC might get a sweet deal at the expense of later investors. Now let's look at that dilution table again. It shows that after all the dust settles and even without many redemptions, the net tangible book value per share for public shareholders could be as low as $7.11. This means for every $10 unit you buy, you're immediately looking at a paper loss of almost $3. And then there are the warrants. Each unit comes with a third of a warrant, which is quite a small piece. So if you buy 3 units, you get 1 whole warrant. That's an interesting structure designed to perhaps make them a more attractive partner for a target business by being slightly less dilutive than if each unit came with a full warrant. The company is aware that they might be considered an investment company, which would trigger a lot of burdensome rules and restrictions. This could really slow down or even stop their search for a business to merge with, so they're taking steps to avoid that, but it's a risk they've had to disclose. Now, putting it all together, Talon Capital Corp is a blank check company with clear ambitions in the energy and power sectors. Their leadership team brings a lot of experience from past deals, specifically in the energy space, which is a good sign. However, the immediate dilution for public shareholders and potential conflicts of interest arising from the sponsor's minimal initial investment are definite red flags they hold. SPAC model always carries risks tied to finding a suitable business within a tight deadline, and that's definitely present here. Looking at the numbers though, the immediate dilution is quite stark, meaning the initial public offering price is set quite high relative to the company's tangible assets in its current state. The warrants being a third of a warrant is also a bit unusual and could affect their overall value. The fact that they might issue more shares at a lower price later through PIPE deals to finance the merger is a common SP practice. Used to finance the merger is a common SP practice, but it always adds to shareholder dilution. Conclusion-wise, Talon Capital Corp seems to be setting itself up with a strong team and a clear focus on the energy sector, but investors should be very much aware of the inherent risks in SPACs, particularly the dilution and the race against time to find a good merger target. This isn't a typical company with operations to analyze. It's just a vehicle for an acquisition, and you're betting on the management team's ability to find and execute a successful business combination. What's your take on Talon Capital Corp's chances? Let us know in the comments below. If you found this deep dive into Talon Capital Corp helpful, give this video a like and make sure to subscribe for more corporate breakdowns. Don't forget to join our Discord community linked in the description below to keep the conversation going. Thanks for watching, and we'll see you in the next episode.